Today, folks, if you love those wicked high dividend yields that are definitely affordable on the payout ratios, look no farther than the Canadian banks, baby. We're talking about earnings yet again. Bank of Nova Scotia kicked it off, and it was a little disheartening. They put a lot of loan loss provisions aside, but we did get some clarity that they were doing that to jump the gun, to stop having to put as many aside in coming earnings, basically getting the worst out of the way now, maybe showing a sign that the banks are finally reaching their final hurrah in this downturn. I mean, take a look, because on the earnings, the stock dropped miserably by 4% and then pretty much recovered the entire losses within the next day, which was pretty incredible to see considering of the October lows that were experienced. We're still up 8% from that with currently a 7% dividend yield. But we've talked about Bank of Nova Scotia, so let's kick it off because we're going to talk about Canadian Imperial Bank, Royal Bank, Toronto Dominion for the earnings that came today. If that is a conversation you'd appreciate, damn it, hit that like button. This is going to be a treasure trove of knowledge for you Canadian bank lovers out there. And Canadian Imperial is currently yielding 6.2% and probably has had the biggest rally thus far. It jumped 4% this morning on its earnings. And I know this is probably one of the most hated of the Canadian banks. It's probably one of the lackluster performers when we're talking about, capital gains. But if you've been buying these bottoms up here, man, it's 15% from those lows. You zoom out on the 5-year here and you can see, we're really trading in kind of the lower end line here. So we got a ways to go, but still, it's still looking like deep value discounted territory, in my opinion. The earnings came out where they beat EPS by 2% and revenue came in actually under at 1.46%. When it comes to the price to earnings multiple, as mentioned, this chart is going to be the defining factor for the recovery that I'm expecting sometime next year, which is why I think we're still in this discounted buying opportunity, because EPS has been dissolving against the backdrop of loan loss provisions and impaired loans. But this is only going to last so long, and they're going to be able to actualize this revenue sometime, I would imagine next year, where we'll start to see a normalization in the recovery of their earnings per share. But because the EPS has been dropping, it's been driving up the price to earnings multiple, leading the stock price down, right? So the question is this a true buying opportunity? And just taking a look, first and foremost, they did actually raise the dividend yet again. They raised it by 3 cents. That is going to start actualizing at the beginning of 2024. So we're getting some dividend increases, which is nice to see. And let's talk about what matters most here to me, which is obviously total revenue. We can see revenue came in at $5.8 billion, which basically from this time last year is slightly lower, but as a whole for year to date, they did $23.3 billion versus $21.8 billion. So there is growth on total revenue. They are seeing a continued incline in basically the revenue. So it's just getting eaten up by these provision for credit losses, which we can see this quarter was actually a lot lower. It looks like last quarter they took a bit extra at $736 million, and this quarter was only $541 million. But for the entire year, $2 billion versus $1 billion this time last year. And if we scroll down here, I always find it neat too that we can actually take a look at some of the dividend data, which is probably the most intriguing for a lot of people out there. And if we take a look, the current reported dividend payout is about 56.9%. They do have an incredible amount of room on an adjusted basis. I mean, the dividend payout's about 55.4%, which is actually inclining to the downside, which is surprising considering their earnings have been deteriorating. They actually have a better payout ratio than they did in the past, which is very intriguing to say the least, right? And just taking a look too, the book value on this is sitting at about $51.61, and currently Canadian Imperial Bank's trading for around $55, so slightly above book value. But Bank of Nova Scotia and Canadian Imperial Bank are by far the two most intriguing banks, as they have the highest yields. Again, Bank of Nova Scotia currently sitting, or Canadian Imperial sitting at 6.27%, and Bank of Nova Scotia at 7%. I mean, that is basic market returns just off the dividends at which both these banks can largely afford to be paying them, right? So just take a look at the loan losses, because this is where things kind of fascinate me the most, is again, people think the real estate market is completely collapsing. And if you zoom in here and you take a look at the actual impaired loan ratios, the Canadian residential mortgages back in Q1 of 2020 were sitting at about 0.3%, whereas this quarter they're sitting at about 0.21%, which have been inclining quarter over quarter, going from 0.13% to where it sits today, but still, 0.9% lower, or almost 1/3 lower than where it was during the, when the pandemic started. And in Q1, that wasn't even right around the time the pandemic actually started. So they're in a good place for mortgages. But as mentioned, personal lending is what's wrecking a lot of people, going from 0.37% in Q1 of 2020 to today, where it's at 0.48%. So we are definitely trending up on Canadian personal lending. Businesses and government continue to incline pretty dramatically here as well. And even though the CIBC First Caribbean is actually doing fairly well and declining, so it looks like their Caribbean assets are actually doing much better than some of these Canadian assets. But it's very intriguing to see that it's not mortgages causing the problem right now in the default rates, or basically the delinquency ratings, right? So you look at something like Royal Bank here, for example, which is also trading up 2.28%. If we zoom out on this chart, this one's had a nice little recovery recovery here as well, up about 4.8% over the last few days, and from the October lows is up about 12%. Royal Bank probably being, the resilient largest company in Canada that proves to be very strong, beating earnings by almost 6%, with revenue coming in just under expectations here. And again, taking a look, Royal Bank hasn't experienced the same kind of decline as these other banks, and I don't know if that has to do with the primary exposure just to the Canadian markets. Royal Bank is really a Canadian focused, bank, and they're not like TD where they have, exposure to the US, which kind of gives them this uplifting because we have great immigration, right? Canada's immigration, people are going to banks. There's only a few of them, right? So they're really just going to things like Royal Bank, which I think has been benefiting them pretty good here. But let's just take a look at the numbers with total revenue first and foremost. Total revenue here coming in at $13 billion, which if we take a look, basically over this time last year where they did $12.5 billion is in a much better place. Total $56 billion versus $48 billion. I mean, we're talking about growth that's continuing to go on here with provision for credit losses still increasing, unlike Canadian Imperial Bank, $720 million over this time last quarter on the year. I think they're sitting at $2.4 billion versus $484 million this time last year, and still posting amazing, basically EPS numbers against the backdrop of these horrible loan loss provisions, right? But what I want to do is also show you the dividend yield here. So dividend yield at 4.5%, the payout ratio is at 47%. I mean, there's so much room for payout ratio control here, right? I mean, they're just sitting in a great place. Everything I look at says this is just awesome. Now, from my understanding, the book value per share is $78.79, which is much higher than the current stock price at $121. The question is that in US, it's probably on the Canadian side. So that's, not the best thing to be seeing. We are overpaying from a book value standpoint, but that's what you get for the best performing bank. It's like buying Apple, in the US, you're going to pay a premium for that no matter what. And taking a look again at loan loss provisions, just like Canadian Imperial Bank, we are seeing an increase on impaired loans, from the residential mortgage side, and going from about 10 basis points to up to 13 basis points, not actually increasing that dramatically, but where we start to see it is in personal lending, going from 22 basis points to 31 basis points. Credit cards are actually somewhat nominal here. They're not doing too bad, but small business, and I've talked about this time and time again, small business is getting absolutely wrecked, going from 109 basis points to 178 basis points. Is just brutal because small business just can't handle this market environment. The rate of inflation has increased so dramatically on them. If they're leasing buildings and trying to run restaurants or do whatever, they're just getting absolutely decimated. It is brutal. So take a look at Toronto Dominion Bank. This one trading down 1.43%. If we do zoom out on the 1 year here, we can see that we are up about 7-8%. Not actually the best performer from the October lows, which comes in as a bit of a surprise, but they missed EPS, but actually beat on revenue. So we're starting to see some of the differences here, as most banks are beating on EPS but missing on revenue. So TD being a very strong grower here and actually being a little bit more nominal on their earnings per share. And I think that probably has largely to do with some of the US exposure. So I'm surprised that TD has been hit as hard as they've been hit. And as mentioned, that could have to do perhaps with the First Horizon deal I believe they were trying to purchase that fell through. And there's just been a few headwinds, but nothing that would materially impact, I would think, the stock price, but that's not exactly what we're seeing here. So taking a look first and foremost, total revenue, let's see, the adjusted was about $13.1 billion. And it looks like they've been seeing an increase in revenue quarter over quarter, total $51 billion versus $46 billion for the year to date this time last year. So they're seeing probably some of the best growth of all the banks from the revenue standpoint. Again, provision for credit losses, $878 million increase in quarter over quarter, $2.9 billion versus $1 billion. I mean, they've seen probably the biggest increase in provision for credit losses, which is quite painful. Let's be real here. If we scroll through and just take a look, the dividend payout ratio, but apparently on the common share, if we're talking about the adjusted payout ratio, is 52%, probably a little bit more accurate to take the adjusted payout ratio. So all in all, taking a look at kind of the book value per share, $56.58 with the closing price of $77, we can see that it's actually the higher yielding banks that are trading at the most favorable values today. You know, these lower end banks like your Canadian Imperials and your Bank of Nova Scotias, but we're seeing fairly reasonable growth across most segments here because net income was down on the Canadian personal banking, but revenue again was up 7%. U.S. retail revenue was down actually 3%. And net income was down 19%, whereas on the wealth management, revenue was up 9%, net income down 3%. Wholesale banking, revenue up a whopping 28%, and net income was down 93%. So again, at most segments of this bank are growing. It's just a matter of dealing with these shakier loans. But if we take a look at the provisions for credit losses here, we can see that basically on the Canadian personal banking, impaired went from 184. I'm presuming these are basis points or millions. It's actually $184 million. as we can see here, to $274 million. US retail, $166 million to $308, almost doubling. Wholesale banking went from, well, there's no wholesale banking numbers here, as we can tell. Corporate went from 80 million to 137 million. So this should be a concern across all banks. We're all seeing a continued growth in small businesses getting wrecked. Loan loss provisions are continuing to increase. It's just a matter of that inflection point if we're going to see it, because interest rates have finally taken their full toll on the economy. If we've seen the full toll effect, then we should start seeing a normalization heading into the interest rate cut cycle. And I honestly still believe, when you look at the payout ratios, unlike a lot of companies that exist out there where their dividends are getting up to between the 6 and 8% range, their payout ratios are usually insanely exuberated, right? Whereas these banks, their payout ratios are still hovering at levels where they have tons and tons of bleed room to continue to deal with the economic environment and putting loan loss provisions aside. Again, I am getting this exposure through VDY right now, which is up 0.45%, giving a little bit more diversity in the financial sector and the energy sector. I think 50% of this ETF, with the two major holdings, 25% being in TD and Royal Bank. We're going to see some of the benefit to the bank growth here. But again, I really think this opportunity isn't going to be around much longer. I mean, you look at how much some of these banks are down from these highs, and I'm just sitting here looking at this. 6.27% on Canadian Imperial Bank right now, and 7% on Bank of Nova Scotia. I'm telling you, come back to this video in maybe a year or two, and I'm very much thinking you're going to say goodbye to these kind of yields. These are very rare opportunities. Not financial advice, just my personal opinion. But what do you think in that comment section below?